Okay guys, so welcome back to our channel EduPendent Training. Today our discussion will be stakeholders in corporate governance and corporate social responsibility. For today's session, that will be quite different with our previous video. If your previous video, I will be the one who will explain or do the presentation. Right now we have the University of Mindanao, actually students of bachelor degree, University of Mindanao, that will taking part for this session. So actually guys, for this semester I have an assignment to conduct or to be an instructor in University of Mindanao. So today's discussion will be presented by the students of University of Mindanao. So we have actually several students here. For the first one will be the Miss Agohop. So this is the group one. They did their presentation, Miss Agohop, and then Miss Kebigas, Mr. Garcia, Miss Laureta, and then Mr. Navarro. So we have 5 students that will present the topic stakeholders in corporate governance and corporate social responsibility. So don't go anywhere, just check it out this video.
Hello everyone, I am Ailey Marie Calorata from Group 1 and I will be talking about the stakeholders in the corporation. Without further ado, let's get started. When it comes to investing in a corporation, there are shareholders and stakeholders. While they have similar sounding names, their investment in a company is quite different. We need to understand that shareholders are always stakeholders, but not all stakeholders are shareholders. Generally, a stakeholder is a party that has an interest in a company and can either affect or be affected by the business. The primary stakeholders in a typical corporations are its investors, employees, customers, and suppliers. However, with the increasing attention on corporate social responsibility, the concept has been extended to include communities, governments, and trade associations. There are 2 groups of stakeholders: internal stakeholders and external stakeholders. In internal stakeholders, we have shareholders, managers, and employees. According to Christine Malin, director of the Center for Corporate Governance Research, and as what I have said earlier, shareholders are excluded from the definition of stakeholders, yet includes shareholders to the concept of stakeholders, but deals with shareholders separately to all other constituents that are also stakeholders. Malin treats shareholders differently from other stakeholders for 2 reasons. First, shareholders invest their money to provide risk capital for the company. And secondly, in many legal jurisdictions, shareholders' rights are enshrined in law, whereas those of the wider group of stakeholders are not. Malin goes on to say that the rationale for privileging shareholders' interest over the interest of other stakeholders is that they are the recipients of the residual free cash flow. This means that the shareholders have a vested interest in trying to ensure that the resources are used to maximum effect, which in turn should be to the benefit of the society as a whole. Managers. A corporation is managed by its board of directors, which must approve major business decisions as they are entrusted by owners with the day-to-day running of their businesses. The managers are primarily interested in the successful operation of the business, as their personal gains in a form of income is directly linked to it. The employees of a company have an interest in the company as it provides their livelihood in a present day and at some future point, along with other benefits both monetary and non-monetary. Depending on the nature of the business, employees may also have health and safety interest. In terms of present-day employment, employees will be concerned with their pay, working condition, and how the company's strategies will impact on this. Of course, the long-term growth and prosperity of the company is important for the longer-term view of the employees. For the external stakeholders, we have creditors, customers, community, environment, and government. But I will only cover these 3, and the rest will be discussed by the next reporter. In discussing the place of creditors as company stakeholders, Malin separates creditors into 2 categories: providers of credit and suppliers. Providers of credit include banks and other financial institutions. These creditors want to be confident that the companies that they lend to are going to be able to repay their debts. It is in the company's best interest to maintain the confidence of the providers of finance to ensure that no calls are made for repayments of funds that they are willing to lend to them in the future, and that the company is able to borrow at the best possible rate. Suppliers have an interest in the companies they supply in two grounds. First, having supplied the company with goods and services, they want to be sure that they will be paid for this and in timely fashion. Secondly, they will be interested in the continuance of the company as they will wish to have a sustainable outlet for their goods and services. Next, customers. Customers are impacted by the quality of service or products and their value. Goods and services that meet the needs and wants of the customers is the primary interest of this stakeholder. If the products do harm to the customers or make them unhappy due to dissatisfaction, then conflict of interest arises. Customers support the company with every purchase they make, and each purchase also shows the company what products and services to invest in further. Increasingly, customers are also more aware of social, environmental, and ethical aspects of corporate behavior and will try to ensure that the company supplying them is acting in a corporately socially responsible manner. Local communities have numbers of interests in the companies which operate in their region. Companies will be employing large numbers of local people, and it will be in the interest of sustained employment levels that companies in the locality operate in an efficient way. However, local communities would also be concerned that the companies in the area act in an environmentally friendly manner. It is therefore in the local community's interest that the companies in their locality continue to thrive, but do so in a way that takes account of local and national concerns. That would be all for my report. Thanks for listening.
The call for environmental changes has progressed rapidly. Kyoto Protocol 2005 managing the greenhouse emission has become a repeated part of doing business globally. In a recent report following the observation were made, climate change becomes a financial problem that results to significant competitive risk and opportunities. BOD, executives, and shareholders cannot ignore these kind of problems. Mallon states that both international and domestic level operation should ensure that the company meets the environmental standards. It should promote sustainability and be environmentally responsible. Environmental standard, it is a self-imposed standards that is anchored on the Environmental Protection Act of 1970, also known as the Environment Protection and Biodiversity Conservation Act of 1990. Mallon emphasizes that ultimately all of these things will affect the company at large and the company itself. A great example would be, I am currently watching a K-drama which is titled Vincenzo. Therefore, Mallon is right. In 2004, Thomas Clark emphasizes the importance of protecting the environment in a stakeholder's perspective. According to him, the competitive struggle to grow a business and accumulate capital has disrupted the natural balance of the earth and threatened life support systems. Companies must embrace the concept of sustainability rather than focusing on profit maximization. Environment is the central of shareholder corporations. Discrete environmental policies were made to ensure that the companies would adopt to these policies and fulfill their core environmental obligations. There are progressive companies listed in Australia, specifically in NAB or National Australia Bank. This organization sets a global reference point for the environmental commitments and management practices. According to them, it is our responsibility to play a part in addressing unprecedented challenges of climate change and to help our customers, suppliers, and employers to do the same. In 2002, NAB became signatory to United Nations Environmental Program State for financial institutions on the environment and sustainable development. In 2007, NAB announced its intention to become a carbon-neutral organization. Consequently, on the same year, NAB agreed to social and environmental benchmark for financing project greater than the US with $10 million. NAB states that they offer the following commitments to their customers. Number 1 is reviewing and continuously improving lending policy. Number 2 is investment choice of customers. Number 3, looking for opportunities to offer customers green choices. And number 4 is possible assisting of business and corporations clients to operate their business in environmentally sustainable manner. My realization would be the environment plays a very vital position in a corporate level. The environment offers a lot of advantage in maintaining a good corporate governance of a company. Employees, employers, clients, stakeholders, suppliers, and even customers should be aware on the policies and protocols of the environment. The society we live reflects the people. Thus, profit maximization shouldn't be our first priority. It should be our environment, and it must have balance as well. Now let's proceed to the government. According to Mullen, government is the key to stakeholders. It makes sure that the companies acts in socially responsible way, taking account of social, ethical, and environmental considerations. It also analyzes corporate trends. It will be looking at various aspects to do with fiscal policy and also taxation raised from the companies. All stakeholders have vested interest in the sustainability corporation. By the end of the year, it's easy to see if a stakeholder have common interest in a company's long-term viability. Shareholder wants to maximize return on their investment, not only by receiving good dividends, but also by making profits when they sell securities in a corporation. Employees are dependent on the corporation. They depend on their salary for them to provide for their family and to their basic needs. While creditors have strong interest in the sustainability of the company. If the company is doing well, therefore, they will get paid properly. Suppliers and creditors are of necessity dependent of corporations, as of necessity dependent upon corporations to continue manufacturing products and services. On the other hand, customers wants to continue trading with the corporations to provide excellent goods and services, while the communities in which the corporations do business or operating manufactures the goods of the business, deliver the service, and provide job opportunities. It also create wealth that leads to the development of living conditions. Second to the last would be the environment. The pearl and is highly dependent on sustainable and environmental friendly corporations. The last would be the government. It has an interest in the sustainability of the corporations because if the company is doing well, therefore they will receive the just taxes that they want. Corporations also provide job opportunities for the people of the communities and the government as a whole. That's why the government focuses its policies to them, because they are the one that sustains the government. Shareholders' interest in the corporation and the role of the law. The anatomy of corporate law. comparative and functional approaches emphasizes the importance of the role of the law. According to the sources, recognition and protection of stakeholders' interest is one of the key functions of company law. There are central issues of corporate law as to how to mediate three different agencies of conflicts between managers and shareholders, majority and minority shareholders, firm, and the third parties. This section focuses on the work environment. Companies must be knowledgeable on how and what they will do with these kind of conflicts exist. Therefore, the company should impose their own specific and standardized rule of the company, and it is very necessary in a corporate governance. Now let's proceed to Australian position. Since the 1st of July 2004, listed companies in Australia have been required in order to comply with the ASX Best Practice Recommendation, as it originally titled in 2003, to have in place and posted on their websites a code of conduct and ethics indicating how they intend to deal with stakeholder concerns and interests. Revised ASX Corporate Governance Principles and Recommendation in 2007 represent Australia's attempt to develop a regulatory framework that promotes and adheres to the best practice in the corporate governance and responds to series of corporate collapse in the earlier part of the decade. From an international perspective, the treatment of stakeholders through the sophisticated development of a model code of conduct is quite progressive, with neither of the recent reform movements in the United States or the United Kingdom directly dealing with stakeholders' interests in terms of how to achieve best practice in the corporate governance. Advices stated on the principle number 3, which is to promote ethical and responsible decision making. It states that companies should not only comply with their legal obligation but should also consider reasonable expectations of their stakeholders, including shareholders, employees, customers, suppliers, creditors, customers, and the broader community in which they operate. Recommendation 3.1 then goes on to provide that to achieve this, listed companies should establish a disclosed code of conduct to guide compliance with the legal and other obligations in order to meet the reasonable expectation of the stakeholders. Code of conduct should include the following: clear commitment by board and senior executives to the code of conduct. This is linked to the vision, mission, core values that all people involved in the business should follow. Number 2, responsibilities to shareholders and financial community. Generally, this pertains to the company's approach to accounting policies and practices and disclosures. The third one would be responsibilities to stakeholders. This refers to the standard and overall operation of the business and as well as fair trading. The fourth one is to approach to community. This pertains to the environmental protection and community relations of the company for its people. Next one would be the responsibilities to the individual. This includes company's privacy and confidentiality policy for all the people involved in the company. Employment practices refers to all aspects of program pertaining to the rights of the employees on and outside of the employment. The next is approach to business standards. This might include how the company regulates such conduct and prevents the misuse of company's assets and resources, and approach to business courtesy. How the company complies with the legislation affecting its operations refer for the company's operation outside of Australia. This code of conduct should state whether those operations comply with Australian or local legal requirements regarding the employment practices, responsibilities to the community, and responsibilities to the individual. The next one would be approach to the conflicts of interest. This pertains on how the company handles the risk and conflicts that the company possible face. It manages the risk while protecting the welfare of its executives and employees. Promotion of ethical behavior. Identify measures that the company follows to encourage the reporting of unlawful or unethical behavior and to actively promote ethical behavior for the benefit of the company. The last would be how the company monitors and ensures compliance with this code. This is to weigh if the company is following the above-mentioned code of conduct listed to so that it would last, it would become a practice, and eventually become a habit for a certain company. But don't worry, ASX Corporate Governance also emphasizes during their suggestion that a company has the free will to include and exclude a certain code of conduct that isn't relevant to their company for their flexibility and mobility of the overall code of conduct. The explanatory text accompanying the original ASX best practice recommendation during the 2003 indicates that codes are intended to the state's values and policies of the company in order to ensure adequate private and public accountability by corporations. And it is anchored on the principle number 7, which is to recognize and management of risk. The compliance aspect of code of conduct should complement the company's risk management practices. Principle 7 states that good corporate governance can be achieved by establishing a sound system of risk oversight and manage internal and external control. Consequently, in 2004, the question whether the corporate governance and especially laws regulating the roles of the company directors should be geared toward safeguarding stakeholders' interests became a hot topic in Australia. This debate emerged from a major controversy concerning the manufacturer James Hardie, but I believe that the next reporter would be the responsible one to expound and explain the cases and controversy of James Hardie. In view of this, the Australian government asked its Companies and Market Advisory Committee in 2005 to consider the report on whether the legislative roles of directors can be changed to a certain degree, to which directors should take stakeholder interest into account, or to enable the directors to do so. So yeah, that's it for my report. I am Giovanni Garcia. I hope that you have learned something, just at least a little bit from my report. Terima kasih, and have a great day.
Hi everyone, my name is Marilu M. Cabigas. Today we're gonna discuss the continuation of Chapter 2, Lesson 3, Stakeholders' Interests and the Corporation, the Role of the Law. For this part, we're gonna learn about the overseas position in regard to protecting the company stakeholders' interests and abiding to the corporate governance principles and company laws at the same time. First, we have the Organization for Economic Cooperation and Development, or OECD, in which their principles of corporate governance serves as a guide in accommodating the interests of stakeholders. The OECD principles state that the corporate governance framework should recognize the right of stakeholders established by law or through mutual agreements and encourage active cooperation between corporations and stakeholders in creating wealth, jobs, and the sustainability of financially sound enterprises. This actually summarizes and discloses the 6 OECD principles there are. This tells us that the corporate governance framework should promote transparent and efficient markets, should protect and facilitate the exercise of the shareholders' rights by first respecting the laws and mutual agreements with stakeholders, second, obtaining effective redress or compensation for the violation of their rights, third, developing performance-enhancing mechanism for employees, fourth, obtaining relevant and material information on a regular basis, fifth, communicating their concerns about illegal or unethical practices to the board and not be compromised for doing so, and sixth, enforcing an effective creditor rights that complements the effective and efficient insolvency framework. These principles also highlights a corporate governance framework that ensures a strategic guidance of the company, the effective monitoring of management by the board, and the board's accountability to the company and its shareholders. Moving forward to the European Union or EU, according to the EU Green Paper, promoting a European framework for corporate social responsibility in 2001, they describe CSR as a concept whereby companies integrate social and environmental concerns in their business operations and in their interaction with their stakeholders on a voluntary basis. Take note, the essential words integrate social and environmental concerns, that is, to help companies be rightfully accountable to itself, its stakeholders, and to the public. Also, the Green Paper describes CSR as follows. It is essentially about companies being prepared to take the lead and illustrate to the Commission and to their stakeholders voluntarily that they take CSR seriously. CSR is always about going beyond the law. Ideally, CSR is a win-win scenario, whereby companies increase their profitability and society benefits at the same time. The Commission also commented on the conflict between maximizing short-term profits and achieving shareholder value by noting the growing perception among enterprises that sustainable business success and shareholder value cannot be achieved solely through maximizing short-term profits, but instead through market-oriented yet responsible behavior. This is essential to notice now that 63% of consumers feel that ethical issues are becoming more important. Companies should eye a market-oriented goal and practice ethical behaviors along the way. A stakeholder-oriented approach to corporate governance is heavily emphasized and promoted in European Union countries. It seeks to bring employers, employees, non-government units, academics, and socially responsible investors every 2 years together in an attempt to raise awareness regarding corporate social responsibility and thereby encourage facilitating exchange of best practices across Europe. In 2006, a renewed European Union strategy on CSR was formed. It was called the European Alliance for Corporate Social Responsibility that promotes CSR around 3 areas of activity. First, raising awareness and improving knowledge on CSR and reporting on its achievements. Second, helping to mainstream and develop open coalitions of cooperation. And third and last, ensuring an enabling environment for CSR. Moving forward, we have the United States concept of corporate constituency with the goal of protecting the interests of company stakeholders. Given that the United States of America is composed of 50 official states, corporate law in this country is regulated at the state level. That means corporate law exists but stands differently from each state. In 1998, over 30 states' legislatures introduced corporate constituency laws that is designed to protect companies in their local economies from hostile takeovers by enabling or requiring directors to consider the impact of their activities on constituencies other than shareholders. Diving deeper into this, Margaret Blair's Ownership and Control: Rethinking Corporate Governance for the 21st Century states that the American corporate constituency makes it legal for directors to consider the interests of others when making major decisions. The interest that we are talking about here is of those employees, suppliers, and customers of the corporations and even the company where it is located. Comparing this to the Australian approach, they are heavily focused on the interests of shareholders and have no regards to the interests of other groups when making corporate decisions. Some U.S. states have recently introduced a new corporate structure, the Low Profit Limited Liability Company or L3C, for business entities whose primary goal is to achieve a socially beneficial objective. Corporate entities are established for charitable or educational purposes. Its profits are the corporate secondary goal, and they are not organized to accomplish any political purpose. This hybrid entity is designed to attract private investment and philanthropic capital in ventures designed to provide a socially beneficial objective that demonstrate the bridging of the gap and a movement away from the traditional boundary between for-profit and non-profit organizations, and is in line with the development of the Community Interest Company or CIC in the UK, designed to meet community needs. Here we have the United Kingdom's concept of enlightened shareholder value that protects the interests of company shareholders. This is an approach to the director's duties, which is described as the duty to promote and hold the success of the company. This is explained in a concept: there will be inevitable situations in which the interests of shareholders and the other participants will clash, even when the interests of shareholders are viewed as long-term ones. Examples include a decision whether to close a plant with associated redundancies or to terminate a long-term supply relationship, when continuation in either case is expected to make a negative contribution to shareholder returns. In such circumstances, the law must indicate whether shareholder interests are to be regarded as overriding or some other balance should be struck. This requires a choice between the enlightened shareholder value and pluralist approaches. An appeal to the interests of the company will not resolve the issue unless it is first decided whether the company is to be equated with its shareholder alone, or the enlightened shareholder value, or the shareholder plus other participants, or what we know as pluralism. Here we have the Section 172 of the Companies Act 2006 in the United Kingdom. The least and matter to which directors must have regard and provide are: first, duty to promote the success of the company. The director must act in a way he considers in good faith would be most likely to promote the success of the company for the benefit of its members as a whole. Second, where or to the extent that the purposes of the company consist of or include purposes other than the benefits of its members. Third, the duty imposed by this section has effect subject to any enactment or rule of law requiring directors to consider or act in the interest of creditors of the company. According to the then UK Trade Industry Secretary Patricia Hewitt, the proposals are part of a wide program of action to boost enterprise, encourage investment, and promote long-term company performance. A new type of company called CIC was established. It is designed for enterprises that wish to use their profits and assets for the public good. As an overview, the new regulatory regime has been designed so that CICs will be: first, easy to set up, subject to adopting suitable constitution and satisfying an objective and transparent community interest. Second, able to issue shares to raise investment, but the dividends paid on those shares would be capped to protect the asset lock. Third, CICs are required to produce annual community interest reports on how they have pursued their social or community objectives and how they have worked with their stakeholders. Fourth, CICs are allowed to transfer assets to other suitable organizations, such as other CICs or charities. While the United Kingdom common law continues to uphold the traditional principle that directors owe their duty to their company and that this requires directors to focus on maximizing profits, the recent introduction of CICs have changed the landscape somewhat by enabling this form of company to give priority to social objectives, with non-shareholder stakeholders being the principal beneficiaries. Next, in protecting the interests of company stakeholders, Canada has no corresponding legislative or regulatory innovation comparable to the position in the United Kingdom, which they have CICs, and the United States, which they have L3Cs. More to this, Canada made the following law reform recommendations in an effort to modernize the organizational infrastructure that applies to social enterprise to better enable its flourish. First is that the Government of Canada enact a Community Enterprise Act, which draws upon the best of recent legislative innovations in the UK and in the USA. Second, the Community Enterprise Act will enable new organizations to incorporate as community enterprises, as they should have the capacity to issue shares to investors subject to limitations on scope of activities and on investment returns, and a capital lock to ensure that assets remain primarily for the benefit of the community. Third is that the Community Enterprise Act should define community benefit and provide a mechanism for entities incorporated under other federal or provincial legislation that meet the test to be eligible for favorable tax treatment and other incentives for the government may decide to establish. Here we have New Zealand's concept in protecting the interests of company stakeholders. Under its Companies Act 1993, it states that the constitution of a company may provide that a director may, when exercising powers or performing duties as a director, act in manner which he or she believes on reasonable grounds is in the best interest of a shareholder or groups of shareholders or any other entitled persons, notwithstanding that such action may not be in the best interest of the company. Emphasis on any entitled persons indicate that they could presumably include creditors, employees, charitable organizations, perhaps even society at large or the environment, depending on how the provision in the company's constitution is framed. Thus, this act embraces a wider range of stakeholders and is not only limited to employees. Finally, South Africa's concept in protecting the interests of company stakeholders in regards to the role of the law is the 2009 King III Report. It is a comprehensive document that sets guidelines for the best practice in corporate governance in South Africa. This articulates benefit in their so-called integrated sustainability reporting and was recognized over and above the financial and regulatory aspects of corporate governance. They have embraced the triple bottom line in which the economy, the environment, and the society is part of the company's activities. King III Report accommodates the interests of stakeholders by recognizing the importance of the relationship between an enterprise and the community in which it exists. It aims to achieve the following. First, every company should report at least annually on the nature and extent of its social, transformation, ethical, safety, health and environment management policies and practices. Second, the board of directors should take into account the environment in which the company operates in determining what is relevant for disclosure. Third, each company should demonstrate its commitment to its code of ethics by creating systems and procedures to introduce, monitor, and enforce its ethical code, by assessing high-level individuals to oversee compliance with ethical code, by assessing integrity of new appointees in the selection and promotion procedures, by exercising due care in delegating discretionary authority, by communicating with and training all employees regarding enterprise values, standards, and compliance procedures, by providing, monitoring, and auditing safe system for reporting of unethical or risky behavior, by consistently enforcing appropriate discipline, and finally, by responding to offenses and preventing reoccurrences. King III calls for an integrated reporting of financial information with sustainability issues of social, economic, and environmental impacts. It also recommends that the audit committee should engage in an external assurance provider to provide assurance over material aspects of the sustainability reporting. The King Report deals with the emerging governance trends that focuses on, first, alternative dispute of resolution, second, risk-based internal audit, third, shareholders and remuneration, and fourth, evaluation of board and director performance. Moreover, there are new issues included in the King Report, which are, first, information technology governance, second, business rescues, and third, fundamental and effective transactions. That would be all for the overseas position in recognizing and protecting the interests of company stakeholders through corporate governance principles and company laws. Thank you for listening and have a nice day.
So, how do you approach corporate governance? Do you protect the interests of your stakeholders, your customers, employees, or business partners? Or are you more inclined to protect the interests of your shareholders, those that give money for your company or extend your line of credit by buying stocks? Or, or are you more inclined to protect the interests of both, deviating to a more integrated approach towards corporate governance, which is in a way utilitarian since it considers the benefit for the greatest number of people that is under the company's purview? These are the questions that I am going to evaluate in my report. I am Daniel J. Navarro, and I hope you listen to this presentation. It is generally acknowledged that protecting the interests of a collection of stakeholders is for the best. But there are some who believe that this way of approaching corporate governance deviates from the strict wealth maximization objective and is utterly unworkable. Let's investigate the point of view of naysayers. So here's naysayer number 1, Michael Malin. He says that another very important point is that if the directors of a company were held to be responsible to shareholders and various stakeholder groups alike, then what would be the corporate objective? How could the board function effectively if there were a multiplicity of different objectives, no one of which took priority over the others? This could actually lead to quite a dangerous situation where directors and managers were not accountable. So, Malin's statement implies that focusing on both shareholders and various stakeholders leads to chaos. It causes the company to have multiple objectives and makes it dysfunctional. Now, judging from this statement, Malin is a person that can't clearly multitask or set priorities. The kind of guy that you wouldn't want in an emergency room. But the person has a point. It is true that multiplicity of objectives can dilute the focus of the company. And I will show that using this equation. So here's an equation for pressure. And from this equation, it will turn into this. So the impact of the result is equal to the effort over the number of objectives that the company has. As the number of objectives rise, the impact of the result falls because the impact of result and the number of objectives is inversely proportional with each other. Okay, so this here illustrates the point of Malin. But is it really wise to be one-sided in your approach? I mean, a corporation is a really huge institution with various amounts of people, various departments, and etc. So, wouldn't it be inadvisable to confine them into one objective alone? According to my uncle, the control of a large force is the same principle as the control of a few men. It is merely a question of dividing up their numbers. So, I think that it's okay to set multiple objectives for the company as long as you delegate those objectives properly to the relevant people inside of the company or to the relevant departments inside of the company. Then everything would go fine. And as long as those objectives are rooted or centralized with much more prioritized objective, then I think everything would work fine. Another naysayer is Mr. Thomas Clark. He says that the difficulty is whether in trying to represent the interests of all stakeholders, company directors simply slip the leash of the only true restraint that regulates their behavior, their relationship with shareholders, in apparently seeking to become the arbiter of the general interest. All that occurs is that executives become a self-perpetuating group of princes. This guy thinks that directors would be corrupted if they were to represent the interests of stakeholders. After all, directors are stakeholders themselves. So if directors were to represent themselves, then there's a chance that they would look after their own interests. After all, power corrupts, but absolute power corrupts absolutely. I can't blame him for his lack of hope for humanity, but couldn't this outcome be prevented by simply enforcing policies? Letters of the law that restrain or restrict the power of directors over doing such things? Isn't that preventable? So I think this scenario should not be the reason why there shouldn't be a focus or there shouldn't be a way to implement an integrated approach in corporate governance. Well, the book, on the other hand, contends for a more holistic approach. It says that an integrated approach to corporate governance by which directors and management not only consider the impact that company decisions will have on the bottom line, but also the broader social, political, and economic impacts of the decision is desirable and is the most effective way to ensure that a company achieves long-term and sustainable growth. This statement is further undergirded by a statement of the same author, which says that the modern corporation is the center of a network of interdependent interests and constituents, each contributing to its performance and each anticipating benefits as a result of the corporation's activities. So in simpler terms, the company is an ecosystem that has multiple players or components essential for its proliferation. So it is important to take care of each of these elements in order to ensure a fluid operation on each of the processes of the company, allowing it to achieve its goals and allowing it to protect the interests of everyone in its purview. So if you only focus, for instance, on the frog, then the fly population would increase and there would be a disruption in the ecosystem, which is bad. If you simply focus on increasing the fish, there would be competition on the food that the frogs eat, and the frog would lose its primary source for food. So it's not good. There would be an imbalance. So try to compare this analogy when it comes to the corporation, and enlightenment will come. Steve Letza et al. On their article worded the concept even better. So they said that rather than justifying stakeholder interests on the basis of moral value and fundamental human rights, the instrumental stakeholder theory legitimizes stakeholder value on the grounds that stakeholder management is an effective means to improvement of efficiency, profitability, competition, and economic success. So they unhinge the concept of corporate governance from its empathic and emotional considerations and or including moral value and fundamental human rights, and inclined it more onto the rational angle which seeks to increase efficiency, profitability, competition, and economic success. Redefining corporate governance this way points corporations away from being a charity for stakeholders and shareholders to a profit maximizing organization that has incentive in taking care of all the constituents under its purview. That ends my presentation. Thank you for listening. Um, Goodbye.
Good day everyone, I am Cheryl Ann R. Aguhob from Group 1 and my topic is CSR and Director's Duties.
So let's start. CSR and Director's Duties is the last subtopic for Chapter 2, the Stakeholders in Corporate Governance and Corporate Social Responsibility. Let's define it. What is corporate social responsibility? It is a self-regulating business model that helps a company to be socially accountable not only to itself, but to its stakeholders and the public. To engage in CSR means that a company must operate in ways to enhance society and the environment instead of contributing negatively to them. On the other hand, directors' duties, its purpose is to protect the shareholders by ensuring that directors can be held accountable for the way that they manage the affairs of the company. So let's broaden our discussion for the director's duties. So here are the director's duties. First is that directors must act within their powers. Company directors must act in accordance with the company's constitution and only exercise powers for the purpose for which they are conferred. The second one is that directors must promote the success of the company. It is an important duty of a director to act in such a way that they consider most likely to promote success of the company for the benefit of its members. This may include thinking about the long-term consequences of decisions, the interest of any employee, and even the impact of company's operation on the community and the environment. The third duty is that the director must exercise independent judgment. Directors are under a general duty to remain independent in their decision-making. While directors are able to take advices from lawyers and accountants, they must avoid being dominated or manipulated by a fellow director or shareholder. This is to avoid conflict that might arise because of the decision being made. The fourth one is that director must exercise reasonable care, skill, and diligence. Directors are expected to exercise the care, skill, and diligence that would be expected from a reasonably diligent person with the knowledge and experience that the director actually has. So directors must have the competence and the ability to lead the company. The fifth one is that directors must avoid conflicts of interest. This is really important because one of the most commonly breached director's duty is the obligation to avoid situations where a director has a direct or indirect interest that conflicts or may possibly conflict with the interest of the company. The duty particularly applies to the exploitation of any property, information, or opportunity, whether or not the company would in fact choose to take advantage of it. The sixth duty is that directors must not accept benefits from third parties. This can be a form of a bribe for a director. There is a general duty not to accept benefits given because of a director's position. However, receiving corporate hospitality is not prohibited, and directors can receive benefits as long as accepting benefit wouldn't reasonably regarded as likely to give rise to a conflict of interest. So, a director must be careful on weighing their decision on this matter, and the company's culture and rules may guide the director when to accept and when to refuse. The last duty of a director is that he or she must declare any interest in a proposed transaction or arrangement with the company. The purpose of this duty is to ensure that the board are fully aware of a director's interest in a proposed transaction before it is completed. The duty also applies where a director becomes interested in an existing transaction or arrangement. This could occur where a director of a company A becomes a director of company B, which is an existing supplier of company A. Now, let us further discuss the alignment or the connection between corporate social responsibility and directors' duties. Most companies are subject to legal requirements that affect the way business is conducted. These include trade practices and fair dealing laws, consumer protection, respect for privacy, and many others. So apart from the company laws and corporate governance principles, there are several sources of legal obligation that are designed to ensure that corporations are obliged to take into account the interests of stakeholders other than shareholders. So in several areas, directors and officers are held personally responsible for the corporate behavior inconsistent with these requirements, and penalties can be severe. This is in connection with what I have mentioned earlier. Company directors can be personally liable by virtue of their position as directors. So whatever the consequences of the decisions made by the directors, they can be held responsible for that. Next is that directors of companies must obey the laws relating to environmental protection, taxation, occupational health and safety, trade practices, and consumer protection, as well as many others. So if the director or the officer act in such a way that is not beneficial for the company and can even affect the community in a harmful way, they can be sued and worse, put into jail. So failure to comply with these laws not only exposes companies to potential fines, but also the directors and officers. So the prominence of corporate enterprises in the contemporary society and their influence in particular companies, the ways in which companies conduct themselves, and the extent to which they are perceived to be taking responsibility for the consequences of their actions can be expected to attract continuing scrutiny. So this gave rise to the need for corporate social responsibility for companies. They must be able to contribute also to the welfare of other stakeholders and help protect the environment aside from their main goal, which is to maximize profits. So the current legal requirements for directors is to act in the best interest of the company. So this will assist them in aligning their corporate behavior with changing community expectation. So to conclude this topic, companies must align their objectives and CSR to their legal duties to promote economic prosperity via long-term business expectations. And with the changing community, society will expect that board of directors will also consider non-shareholder interests through the conduct of corporate social responsibility programs.
And that concludes our presentation. Thank you for your time and good day.
Okay guys, so what do you think after you are seeing the presentation? So the students of bachelor degree University of Mindanao, they are taking part to our discussion today. So If you notice, we already discussed stakeholders in the corporate, an overview, what is actually stakeholders, and then several bodies in stakeholders. And also, there are already discussion stakeholders, interest in the corporations. Yeah, there's also several countries they already discussed, and then the last one is corporate social responsibility and director's duty. That will be the presentation today. So that will be the end of our discussion today, stakeholders in corporate governance and corporate social responsibility. Thank you for watching.